So I like to think I make pretty down-to-earth investing videos. I generally try and avoid speculation, I avoid trendy stocks, I avoid hype, and instead I just focus on rational thinking and rational investment. And that has led, to a fair bit of commentary from myself about how, the market looks very high, almost nothing is cheap at the moment, how inflation might hit hard and send the stock market down and so on. So today I wanted to take the complete opposite stance. I've said my piece on why we may see some sort of market correction at some point in the not too distant future. And now I'm going to explain the reasons why that may not happen. So with that said, let's get stuck in and discuss. This video is sponsored by Stake. Sign up today for free brokerage when trading US listed stocks and use the referral link in the description for a free stock when you fund your account. So I think when taking the opposite viewpoint, that the markets are fine and definitely won't crash, there's probably 3 points we could lean on. And the first point I wanted to start with is inflation. So as I've discussed many times on the channel in the past year or so, right now the Federal Reserve is printing a lot of money. They're virtually adding zeros and buying up financial assets to to inject money into the system and keep interest rates at practically zero. Now, unfortunately, a consequence of this increased, abundance of money is inflation. And we have seen that, in the past few months, we've seen quite a high inflation rate. We were getting used to inflation being between, 1 and 2%. Now it's climbed up to 5.4%. And people have been worried that this inflation is going to keep climbing. One of the people leading in that opinion has been Michael Burry, of course. He's been calling out potential hyperinflation in the United States. And if that were to happen, then the Fed would raise rates and that would pull the markets back down to earth. However, let's not dismiss the fact that the chair of the Federal Reserve, Jerome Powell, the guy in charge of pulling the levers, has said many, many times now that the Federal Reserve is of the opinion that this inflation is transitory. This means they expect inflation to run high for a bit and then just come back down. And the reason they believe this will happen is because in the last 18 months or so, we've seen supply chains really choked due to obviously all the lockdowns, and we've seen demand naturally building up. This is naturally an inflationary force, but now we're seeing the opposite. The supply chain is getting back on track and lockdowns are becoming less frequent around the world as vaccinations rise. So the Federal Reserve believes that, from here, we will see the supply side come back up to meet the demand once again, and thus the inflationary force will diminish. But how does that mean that we likely won't see a market crash? Well, it's because if the inflation is transitory, the Fed won't be forced to raise interest rates. So raising interest rates is the way to stop inflation, but it also, puts the brakes on the economy. It tightens the money supply, loans are harder to get, and usually the stock market and the real estate markets come under pressure. Now, the reason I wanted to make this video now is because we actually just got August inflation data out of the US just the other day. So as you saw before, the inflation rate has been climbing. It's climbing up to now around 5.4%. Then it seemed to stabilize. It stabilized for a month. But the question is, well, where to next? Well, this month's inflation number came in, and it shows in the last 12 months we've seen 5.3% inflation. Now, technically, that is a trend in favor of the transitory inflation argument, but, unfortunately, it certainly isn't definitive. So we really will have to watch the next few months to see if that downward trend gets stronger. If it does, then the Fed simply won't need to raise rates, and thus the stock market will avoid that pressure. So that's really reason number one why the stock markets may not crash, because inflation will calm and nothing will cause the Fed to raise rates. So in the eyes of the big money managers, stocks are still the place to funnel money instead of bonds, despite being very overvalued. And that's actually something that Ray Dalio explained in a recent talk. So I'll play a quick clip here.
So for example, let's say if we were to take the bond yields, the bond yields are at extremely low levels. And so think about bonds as having a multiple. The multiples of bonds are, like 75 times earnings or something, depending on what bond market you're operating in. And so when stocks compete with bonds, they're competing with low returns. And so it's not unreasonable to think that the stock market could have a multiple of 50 times. If bonds have a 75 time multiple, why can't bonds? And that means a low return.
Now, Ray kind of trips over his words a little bit there, but hopefully you can still see his point that, in ultra low interest rate environments, to big money managers, stocks still look like a much better place to park money than in bonds. And if that remains the case, then the market isn't going to face any real pressure. So that's the first big point as to why the market may not crash in the next little while. But there is one more really major point, and forgive me for this next section because I've actually said pretty much this exact argument in a prior video, so my apologies for the repetition. But one key reason we may not see a market crash is because the big American companies are not struggling. And in all honesty, a lot of them really didn't even struggle during the lockdown. So let's look at the S&P 500. So the top 10 stocks make up 29.79% of that index. Honestly, that is quite remarkable. 490 stocks make up 70%, and then 10 stocks make up 30%. So the S&P 500 is really, really top heavy. And in all honesty, the S&P 500 is the index that people turn to when they discuss the American market. So really, the top 10 stocks are going to have a very big say in how the overall market is going. And while in the past we've been discussing how the market looks expensive and how everything's overvalued, the reality of the matter is that if these companies keep performing well, they continue to prop up the market. So how well are these companies doing? Well, I went and I actually listed the top 10 stocks in the S&P 500 and their weight, and then I decided to see how their Q2 net income compared with Q2 last year, 2020. Have a look at this. Every single company is doing better now than they were then. A lot of them are doing drastically better. It's really quite incredible. And even though, despite performing well, they are all still really quite expensive, usually it takes some sort of negative catalyst, a negative stimulus to send a stock sharply in the other direction. And when we forget about the macro and we just look at these individual companies, it doesn't seem like they are going to start struggling anytime soon. As I said before, most of these stocks didn't even struggle during the height of the lockdown. Apple did well, Microsoft benefited, Amazon really benefited, and Facebook and Google did as well. So when you look at it, even if the other 70% of the S&P 500 isn't doing as well, the fact that these top 10 companies are doing so well is, quite simply, it's more than enough to keep that index going up. So that's really the second key point as to why the market may not crash in the next little while. Then moving on to the last point that I could think of, this point honestly is much more general, much more broad, and the point I thought of is quite simply, we're not really doing so bad anymore. I mean, you think about where we were 15 to 18 months ago. We had a rapidly spreading disease. We had no way to cure it. We had to essentially lock the world down. We had to halt all business. The supply chain stopped. At the time, we weren't sure what the central banks of the world were going to do, if they were going to step in and how much support they would provide. Honestly, that wasn't a great time, and fair enough that the market plummeted. But now we have a way to cure this thing. We have vaccines being produced in high quantities, and the trend certainly is opening up as opposed to closing down. Where we are now versus where we were 18 months ago, honestly, we're doing much better. Usually for markets to crash, as I said before, it takes some sort of negative catalyst. Now, not always, but in most instances, it takes some sort of crisis. For example, September 11 or Cuban Missile Crisis, Pearl Harbor, global financial crisis, those sort of crises. But now it doesn't really look like a crisis anymore. Now, granted, there's still a long way to go, but the trend is certainly moving in the right direction. So chances are it will probably take something else to shock the market if the next crash we were to see was going to be triggered in that sort of way. But overall, that's my kind of opposing viewpoint to the one you normally hear me talk about. I think it's always a good idea in investing to, consider both sides of the argument, kind of battle back and forth. So, definitely let me know where you stand. Let's put a parameter. In the next 2 years, do you think it's more likely that we'll see some sort of stock market correction? Or do you kind of think the markets will just keep plodding along as they have been? So definitely let me know. I'd be very interested to hear what you guys have to say on this topic. I'm sure we'll get multiple opinions in both kind of camps. So definitely let me know. And if you like this video, make sure you leave a like on it. Subscribe if you haven't done so already. Check out the New Money Clips channel if you're interested in even more shorter form content. That kind of doesn't make it to the main channel, but still content that I want to make. I'll put it up on New Money Clips, so you can definitely check that out. And if you're interested in how I go about my investing, passive or active investing, then check out PROFITFUL. I've made 2 courses over there on investing. We've also got courses on tax as well. If you're interested in learning about how you are taxed with your investments, that's for Australians, but in any case, check out PROFITFUL if you're interested, but I'm starting to ramble. So thanks very much, guys, for watching, and I'll see you guys in the next video. So a lot of people ask me what brokerage site I use when I make an investment in the US, and for about the past 3 years now, I've been using Stake. So Stake is a brokerage-free trading app that lets you buy US stocks, and coming soon, they'll also be offering ASX trading as well for all the Aussies out there. So brokerage-free trading, that's pretty awesome, but the other reason I like their platform is because of fractional share trading. So say you wanted to buy Amazon, current share price is $3,450. It's pretty expensive. However, with fractional share trading, say your investing budget was like $500, you can just buy 0.14 of an Amazon share instead, no worries at all. So I definitely recommend Stake, and if you wanted to jump on board, follow my referral link in the description when you sign up, because if you do, you'll get a free stock, either Nike, GoPro, or Dropbox. So the time of recording, at worst, that's $9 US in your pocket. And if you hit Nike, that's $158 US for free. So definitely check them out, get your free stock, and thanks always to Stake for sponsoring the channel.